Good afternoon, ladies and gentlemen. This is Susanna Wong, Senior Manager of the Market Outreach Division at the Hong Kong Monetary Authority. On behalf of the Alliance for Green Commercial Banks, I'm very pleased to welcome you all to join today's event, Green and Sustainable Market Evolution Roundtable, co-hosted by the Alliance and Standard Chartered. Today, the Alliance is hosting the fourth roundtable. In this roundtable, we aim to take a deep dive into the latest developments and future of the sustainable finance. Issuers, investors, regulators, and banks industry experts will share insights from different lenses, including evolution of their segments over recent years and the challenges ahead, providing a holistic picture of the market, and more importantly, a vision on the opportunities ahead in Asia's sustainable finance landscape. In this session, we're delighted to have 4 panel speakers for the roundtable discussion. Please join me to welcome our panel speakers today. Mr. Kenneth Hui, Head of Market Development Division, Hong Kong Monetary Authority. Mr. Julian Lee, Executive Director, Finance, Airport Authority of Hong Kong. Mr. Rahul Sheth, Global Head of Sustainable Bonds, Standard Chartered, and Ms. Emily Woodland, Managing Director, APAC, Co-Head of BlackRock Sustainability Investing. The discussion will be moderated by Ms. Tracy Wong-Harris, Head of Sustainable Finance Asia, Standard Chartered. Participants are welcome to pose questions for the floor Q&A session. To kick off the roundtable, may I pass the stage to Tracy? Thank you.
Thanks, Susanna. Thank you everyone for joining today's Green and Sustainable Capital Market Evolutions Roundtable. I'm very excited with our lineup of speakers today. And maybe I think it would be good to start with all our speakers to introduce themselves with what do they do at their day job, so that to give everyone a view on their development in sustainable finance, their role. So with that, shall we start with Emily?
Thanks, Tracy. It's great to be here today. So look, a brief overview. BlackRock Sustainable Investing's team consists of over 60 professionals across 8 offices globally, and they're dedicated to providing the firm and our clients with a clear picture of the relationship between sustainability issues and risk and long-term financial performance. And we will have 13 people in the APAC team by midsummer this year. So the team basically acts as a central authority on sustainable investing that helps really oversee the strategy and the development and the implementation of sustainability across BlackRock's whole investment platform. And they're focused on 4 main activities. So the development and the oversight of our dedicated sustainable platform solutions. Secondly, advancing ESG integration across our whole active platform. Thirdly, providing research and insights that are used by our different investment teams, by, for example, analyzing sustainability related data and its materiality or causation and performance. And then fourthly, building data analytics and offerings within the Aladdin technology platform that are used by both our investment teams and our clients. So just brief overview of what we do all day, every day. Thanks, Tracy.
Thanks, Emily. Ken?
Thank you, Tracy. It's great to be here. DHKMA, as many of you would know, is the central bank of Hong Kong. We do bank supervision as well as we manage the reserve of the Hong Kong government. At DHKMA, we do a few things on green and sustainable finance. As the bank supervisor, obviously, we set bank regulation, prudential supervision related to climate risk management, and also how we can better promote banks to channel more funding to green and sustainable causes. As the reserve manager of Hong Kong, we figure out ways to incorporate ESG and green and sustainability into the management of our reserve to better manage risk, as well as to raise awareness for the broader market. And finally, as the infrastructure operator of Hong Kong, and that's also what we do at the Market Development Division, we focus on building the ecosystem and infrastructure for green and sustainable finance in Hong Kong. What we mean are things like awareness, talent, data, as well as how we can lead by example. So things that we've been doing include, for example, helping the government to issue its green bond, working with other regulators to promote capacity building, as well as how to fill the data gap, which we can talk more about at the session today. Thank you.
Thanks, Ken. Julian?
Thank you. So I'm the CFO of the Airport Authority of Hong Kong. Essentially the airport operator of Hong Kong. We are in the midst of constructing the third runway, so a very capital intensive project. I guess in my role, I'm responsible to oversee all the financings of the for the Airport Authority. I think earlier this year, we have issued our inaugural green bond as part of the financing for our third runway, essentially finance the capex. So in that capacity, I work very closely with the sustainability team to figure out what's the right format, also development of the whole framework, sustainable finance framework for the authority, and also have a deep discussion with the second opinion providers to ensure that we are somewhat in line with the goals. And so I think that's somewhat my capacity. In addition to that, I think in the development of the third runway, we early on we have dedicated a fund to enhance the marine environment, also the fishery as well. So this dedicated fund that the authority have put aside on a trust, and I'll also oversee somewhat the return and asset management of that side.
Thank you, Julian. Rahul?
Thanks, Tracy. Good afternoon to everyone. And as Tracy mentioned, I head up the Sustainable Bonds practice for Stanchart. And really what I do gets together regulators, investors, and issuers, the three people who've spoken just before me. So essentially, what we do in our roles is really advise issuers in terms of how best they can structure their green, social, sustainability, or transition bonds. Work with regulators in terms of understanding regulations and the impacts of that on issuers as well as investors. And then, of course, when it comes at the end of the day, we all solve for the final outcome, which is getting the investors the product that they're looking for. So people like Emily and funds which support ESG issuances. So really, it brings together everyone that you see on the panel together, and really looking forward to speaking more on this as we go through the panel today. Back to you.
Thank you, everyone. I think you would all agree with me that sustainable finance market has experienced tremendous growth. And last year, sustainable finance market size has exceeded $1.6 trillion and more than double globally and triple in Asia. So with that, let's kickstart and dive into hearing from all our speakers the latest trend and developments in your particular segment and how you've seen your segment has evolved over the past few years. So with that, let's follow on from Rahul from the market perspective. Why don't we start with you, Rahul?
Sure, absolutely. And Tracy, look, as you mentioned, the volumes each year has been a record year for the sustainable debt markets. And practically we've seen, every one and a half years, we've seen a new product emerge that has sort of been the flag bearer in terms of keeping the momentum alive. So just looking at bonds per se, we hit the quintessential $1 trillion mark last year in terms of the ESG bond umbrella. And we've been keeping pace this year, despite this being a fairly challenging year with the rates volatility, amongst other things. What we've seen in terms of trends is what used to be about a couple of years back, or maybe 3 to 4 years back, what used to be pretty much a green bond only scenario, and by only I mean about 75% to the plus was dominated by green bonds, slowly shifted over to social and sustainability bonds, or with the start of the pandemic, where while these products were in existence, it sort of came to the fore with the pandemic, where we saw governments fund their pandemic budgets in huge numbers. And typically when governments fund their budgets and come to the bond markets, the numbers and the volumes definitely go up. So we've seen tremendous impetus to social bonds, and in that, slowly that spread to sustainability bonds, which combines social and green projects together. So what we really saw was while the total absolute numbers of each and every type of bond variety go up, we did see effectively green bonds come to about 50% of the total mix, from 75 to 90% over the past few years. And that place was taken over by social and sustainability bonds. But the more interesting part that happened over the last 1.5 years was, or now closing up to 2 years now, is the birth of sustainability linked and transition bonds. Now, both these products came about in about 6 months from each other. And what we saw is SLBs, which is a product slightly different from the products or its precedent products, all of which required a use of proceeds concept. It was slightly different in the sense that it sort of put an overarching target on the organization that was issuing, without putting any load or restrictions on where the monies are being used, with the whole premise being that if monies are being used properly, eventually the company issuing the kind of bond would meet these targets. And what these targets are essentially green and or social targets. So essentially, a lot of it is to do with sort of the decarbonization trajectories of a number of harder to abate sectors. And finally, I'll mention this, that up until now, I think we had products that suited green issuers or neutral issuers. SLBs and transition bonds are products that fit very well the harder to abate issuers, where they can safely come to the market without any issues around, or at least be cautious, be confident that they won't be blamed for greenwashing, which has been one of those issues that the industry has grappled with for a while. So this product has taken over 10% of the market already, and in a $1 trillion market with just 1 year in existence, it has done, it has sort of set a trend, and we see most of the conversations with clients trend towards this. So that's what I would say, Tracy, is one of the key trends in the market.
Thanks, Rahul. I cannot agree more in the sustainability linked product development and together with transitions as well. So it opened up a large chunk of the market that previously moved away from the use of proceed base to link to the company's sustainability target, including the decarbonization pathway, with a more transparent tool, I say, in the market. And I have seen that it's been well received from the investor side. In that sense. So with that, let's go to Emily from the investor perspective, hearing from the market, and I think from BlackRock, from yourself, from the company perspective, what do you see in the past few years, the developments and trends?
Thanks, Tracy. Well, look, the way sustainability is involved in APAC investment management in the last few years has really been quite diverse across geographies, actually. So some countries have been more market-led and others have been a little bit more regulatory or compliance-led. So we'd probably say Australia is the most mature market in the region, having considered these issues in various forms for decades. And like the more well-developed markets in Europe, it really evolved more from a values-oriented perspective, which means a heavy lean on things like exclusionary screens as a tool. And then the next market that followed in APAC was Japan, and that started to pivot from around 2016 onwards, when its major asset owner took a strong leadership position, and then the ecosystem then effectively evolved around it. And what we really observed here that was interesting was a leapfrogging over the traditional questions of values and exclusions to really kind of more deeply and holistically interrogating the link between sustainability and performance. And now what we're seeing is other markets in the region are at varying stages of development that combine elements of both of those two things, with influence from both regulators as well as pivotal asset owners in each market. And it's really quite an exciting time, because we've got this golden opportunity in APAC to really learn from best practice elsewhere in the world and really approach sustainability with a deeper level of sophistication as a result. What we're seeing is asset owners in the region really do vary quite a lot in terms of their approach to sustainable investing and where they're at in this journey. And we can sort of think of them broadly in 5 main archetypes of the different stages of that journey. You've got those who are still kind of very much at the exploring side of the journey and just looking to develop an informed view on sustainability. And then you've got those who are looking to just comply with minimum regulatory and societal requirements. And then you've got those who are seeing alpha opportunities in sustainability. And then the next stage along, we'd say kind of there's those who believe in that performance argument, but then also want to look to direct their investment towards doing good. And then lastly, those catalyzers who really want to look to shape the sustainable investing industry and drive societal change. And in terms of investor type and investment styles that we're seeing, broadly, we kind of notice interest from retail and wealth clients, particularly on the sort of thematic and the impact investing end of the spectrum, where there might be alpha opportunities that are aligned to sustainability related tailwinds, or perhaps an alignment with their own goals and real world outcomes. And then institutional clients are really kind of looking at the core building blocks across their whole asset allocation, essentially really looking at how to integrate sustainability holistically across their whole portfolio. And I'd say in both cases, the major focus of late has really been on climate change and the net zero transition. So at a minimum, many of our clients are really looking to BlackRock to help them navigate the transition via the right tools, the right analytics, the right portfolio solutions that are really going to help them position appropriately for the risks and opportunities that will be associated with the transition. Because for us, kind of, that transition is happening, it's here, it's not really a question anymore. So you've really got to figure out ways to navigate it. But actually other clients might be looking one step beyond that and looking at ways to actively drive and invent the transition through their portfolio positioning. I think going forward over the next 3 to 5 years, as that trajectory of the transition becomes a bit clearer with policy and technology development, I kind of anticipate that focus evolving beyond questions of just climate change to perhaps the broader sphere of biodiversity and natural capital, both in terms of risk, but also potentially nature-based opportunities. And then beyond just questions of the E, perhaps a more deliberate and targeted approach to accounting for the very broad spectrum of S issues that are currently being addressed more from a bottom-up perspective at the moment. So I'll stop there, but that's just a brief overview of what we're seeing here at BlackRock at the moment.
Thanks, Emily. And I do agree with you on the observations across Asia. The journey across the depth and experience across the whole sustainability journeys varies a lot. A lot more. I can't wait to hear for the challenges in the future questions later. And with that, can we switch to Julian from the corporate perspective, from the Hong Kong Airport Authority's perspective?
I think Rahul and Emily have really teed up, I guess, my experience in the inaugural issuance of a green bond. I think I'm aware of the trends of SLB, sustainability linked bond, and also the green bond, right? I think various financial institutions have introduced me, various pros and cons on the two formats. I guess the first thing I need to decide when I think about issuing an ESG related, financing, is to decide on the format. And actually we deliberate quite hard on this, because I think first, for aviation, I think it deems to be somewhat a carbon intensive sector. Not necessarily the airport itself, but other reasons, such as obviously airlines, aircraft, you name it. There's other factors that's somewhat beyond the airport control. So I think that and sort of like to make it even more challenging, right? I mean, we are in the midst of constructing third runway system in a very, very major hub in Hong Kong International City. And so I think that and also in the very initial stage when we started the third runway project, there's a lot of stakeholders, including environmentalists, a lot of comments, I would say controversies, and that's common and in any sort of like major infrastructure project. And so we're also quite conscious about the potentials of trying to reunite at those sentiments. So we have to be careful in terms of figuring out like how we're going to structure it. There are not that many sort of like green bonds or sustainability bond issued by our peer airport as well. So there's not that many sort of reference. I mean, maybe 1 or 2 in Asia, more in Europe, and maybe in Australia. And so I think there's not a lot of precedents for us to follow. I think adding to that, right, towards end of last year, we just announced our net zero target and our pathway. And also at that time, we also completed our climate resilience study. So we were like trying to match the timing of all this together and figuring out like how we structure this to the best way. Even when we structure the climate sort of like reduction, right? I mean, the carbon reduction pathway, we actually deliberate on like the, whether or not we purchase carbon and all these. And also in our journey in looking into all the science and linking all these together, right? Some of the indicators could also be challenging. I mean, previously, some of the old indicators, were quite common, such as carbon intensity, right? When you hit COVID, if you look at carbon per passengers, right, it becomes a very challenging target to reach. And so I think given all these evolutions, right, and also the fact that we are inaugural issuance on green bond, we stick to the green bond format. But even by itself, it's also not easy because the use of proceeds is for building for new airport. And so some of the investors, right, I mean, as Emily pointed out, have very wide spectrum. Some would even argue that building airport is still no good because it also enhances further carbon printing if it's at full capacity. So we have to work pretty hard to figure out ways to addressing all this concern and issue, even though I think we have all the good intention to building the greenest airport, one of the greenest airport in the world, which is one of our goals.
Thanks, Julian. I think this is a very good sharings on the consideration, given that we call, with your own development of the net zero pathway, and in addition with the whole thematic of, I call it green to rainbows now, right? So from Rahul saying that traditional green to GSS to now GSSS with the sustainability link add to the S to the category, right? So it's a lot of decisions need to be considered from the corporate perspective. I want to take a pause here. I don't know whether Rahul or Emily or Ken have any want to respond to Julian before I go to Ken on that perspective.
No, I think that's, in fact, we had the pleasure of being associated with the transaction, so that was great. I think absolutely that shows how the bond market has really evolved. So in terms of, if I look at the quantum of green money, if I look at sort of dedicated funds, it is still the green bond funds that dictate or dedicate, in terms of potentially have the highest dedicated pools, and I'll invite Emily for her views there, versus when we compare to the newer varieties potentially. So that is really the way the markets have evolved. So I think that's from giving the market a transaction which firstly was very liquid, done at the right time in the year. I think we've all seen how markets have shaped up over the quarter. And at the same time, I think allows investors, as Julian mentioned, to have taken a look at what is out there in this space in both across Asia as well as across Europe. I think that makes for a good sort of an entry into the market, being able to sort of put the credentials out there. And as this market evolves, I think we'll definitely see innovation is a given, and I think in this market, and I think investors and ourselves as intermediaries and issuers, we see things change, evolve as we go in time. As Julian mentioned, net zero targets being set. That's again a big sort of step in that direction in terms of target setting.
Thanks, Rahul. Shall we go to Ken? So I think, Ken, you can cover so many different angles in this perspective, from being one of the biggest Asian sovereign green bond issuer to, managing the biggest reserve fund to the regulatory space. So Ken, over to you.
Yeah, thank you, Tracy. Well, I very much agree with what you said in your introduction, that growth is really the highlights of this market over the past few years. Rahul has already highlighted a few very interesting developments on the product side, product innovation. So I won't repeat them, but I think qualitatively in terms of the nature and composition of the market, we are also seeing some rather interesting changes. First is the type of issuers. As we all know, the green bond, sustainable bond market started off with some pioneering issuance by international organization, and then it was taken then a step further by some sovereign issuers. And obviously, there are also quite a lot of interesting corporate issues as well. In perhaps more specifically to Hong Kong, we've always seen a lot of corporate issues from the mainland, but last year we saw some new breakthrough, which was the issuance by the Shenzhen municipal government of the first offshore RMB green bond. So I thought that was interesting because, as many of you know, mainland China has made a big commitment to achieve carbon neutrality by 2060. And I mean, the estimated amount of investment varies, but the size is really huge. And it's not just incurring at the corporate level, we're also expecting local government to bear quite a lot of the burden. So if this route works, and I think the Shenzhen government shows that this offshore issuance channel really works, witnessing the enthusiastic response of investors, I think we can see more of these to come, and that really would change the whole composition of the offshore market. So that's one area. The other area I think interesting is in terms of the size of issuance. Previously, we've been always focusing on the larger kind of corporate issuers, partly because we've always think that there is quite a high entry barrier. You have to do your green bond framework. You have to get an external reviewer to look at your bond before you can actually do the issuance. But we've always been thinking about how we can populate this concept to the smaller, maybe not the small enterprises, but at least the medium one. So last year, we expanded a scheme that we have for subsidizing the external review cost of bond and loan issuance. And to our slight surprise, actually, we actually saw very good take-up of this new kind of lower threshold issuance. And we can really see that smaller issuers are taking this green and sustainable financing channel quite enthusiastically. And I think given how important SME are to most economies, this really would be useful in broadening the reach of green and sustainable finance. So I think the nature of issuers as well as the smaller sizes is quite a quite encouraging development in this space.
Thanks, Ken. I agree. The continue pushing down the capital structure from the big guy to the smaller guy to, from the large corporate to the SME and to further, I'm sure you will share later on as well. So I think this journey is very, very important. And I have to say the subsidy program from the grant scheme that, from the client's perspective, we have received some applications across, is well received, across the bonds and loans, and then also the ticket size, like lower down to the lower level, really help the SME perspective. So thank you. With that, I think all our speakers kind of alluded to, some of the challenges that, from their own journey in this perspective. I want to dive into a little bit more from everyone's perspective. From that front, I think let's go to Julian. Go back to Julian. I think you ended your first questions on some of the key challenges. Can you dive into a little bit more from the AA in terms of moving away from the thematic decisions that you share? Are there more key challenges or burning issue that you see that you want to share with the audience here?
I think that the interesting thing for the authority is that we actually have been working on the particular issue on E for a long time, irrespective of the green market development. I think we were very conscious about the issue given at the start of the third runway projects, and we have been looking at environment for part of our corporate goal, right? As aiming to be one of the greenest airport. Now, as part of that, right, we have this carbon net zero target development anyway, irrespective of the green market development. And so I think while we were deliberating on the format, right, I think and obviously the way to go pathway is one importance, right? I wouldn't rule out that at one point we might go for a sustainability link financing, and that may link to carbon reduction. But I think when we were deciding about the carbon reduction, and that might come across with the carbon market later on, is we actually decided not to purchase carbon credit as part of reduction, at least for the interim, right? We target to reduce 55% of our greenhouse gas emission and what we call limited scope 3, scope 1 and 2 and limited scope 3 by 55% by 2035. And we decided not to purchase credit. I think one of the key reasons was that we actually would like to spend the credit on some meaningful low carbon credit projects. So I think when we think about spending this money, I mean, we much rather that have that money to spend on a credit, a carbon positive story that is more relevant to Hong Kong or Greater Bay Area, so that it actually people would feel that there's a connection with the carbon reduction. So initially we thought about purchasing credit, but I think we actually thought about that and basically say, okay, why don't we, if we can not purchase the credit, if we can do it by ourselves, let's do it by ourselves the interim, and hopefully by 2035 we could see some positive projects that that could be correlated to the market, and so I think that's the way that we choose to pursue it. I think it is still a journey on the carbon market. I think it is a relatively new concept, and so while the market is developing, right, I think at least for us, right, we would like to see some story behind the carbon credit and actually a linkage between the issuer as well with the carbon. I mean, there are many people come to us say that it is a ton of carbon is still a ton of carbon. I do agree with that. But on the other hand, I think if we somewhat have a linkage with some issuers, I think that would actually make the story a lot easier. The second challenge that I also see, right, which when I was talking to sort of like all the market practitioners, right, be it the second opinion providers or even ESG bankers, right? I think there's given the area is relatively new, there's a severe shortage of talents in this space. I think you would end up, actually there's only usually you have two categories, right? You have either seasoned financier who are new to the ESG market, right? Obviously are very cohesive in terms of talking about the whole financing market, but not necessarily in the ESG space. Or you have the vice versa, where you have more academia or consultant, where they would have imagined how ESG should develop, but actually have very limited understanding in terms of finance space. So obviously it sort of takes time for the two expertise to match together. I guess it's helpful for me that I actually have engineering training, so it's sort of like have the two meet up together and sort of like revive up some of my old training 20 years ago in my undergraduate. But I think that obviously is one of the challenges that we have to overcome, where you have a ESG specific cohesive financier to look at this.
Thank you, Julian. On your two topics, very burning. So carbon credit, I can spend a whole day talking on that point, but I will just highlight two things. So carbon credit plays a very, very important role, but what you highlighted is the key issue that what we need to address. The quality varies a lot in the market, and the importance to have the high quality carbon credit fungible across market is super important, and that will help to facilitate this. And with that, I would just do a plug on the ICVCM platform, where there's an international platform that is being currently working on driving a core carbon principle that drive the international voluntary carbon credit standards, and hopefully the draft and will be published very soon in a few months' time. So watch this space. And secondly, I think I see all the speakers are smiling on this point on the gap, the talents gap between the green and sustainable finance is a mixture, like you mentioned, the environmental camp and the finance together. And the market is absolutely shortage, given that, the funding gap that we need to address. So with that can I bring Ken to share some of the initiative that, from the cross-agency steering group and from MA is driving for positioning Hong Kong to fill that gap. And then I will bring Emily and Rahul in and to share that fronts as well. I think we're all feeling the same and have the same perspective. So thanks for bringing this up, Julian and Ken. Let's go to you first.
Yep, sure, Tracy. Very much agree that talent is a big issue, and also very much agree with what Julian said. Green and sustainable finance has been a very hot topic in the past few years. So we do see quite a lot of training programs kind of springing up over the past few years. But I think what we've noticed is that a lot of these training quite ad hoc, quite short term, and not very coordinated. So it's kind of very difficult, very expensive for people, either prospective entrants into the financial sustainable finance field, or people that are already in finance to really take up good training courses. We have been working with other regulators in Hong Kong, as well as the financial and environmental policymaker, together with the industry and the academia to try to plug this gap. So one thing we do is, we're doing a few things. So say, for example, our banking colleagues is now developing an enhanced competency framework, basically a training framework for people in the banking industry for green and sustainable finance. So there will be different components that practitioners can take up to work towards a more kind of holistic training and certification in this field. So that's one area. The other area that we're working on, again, kind of taking a leaf from the grant scheme that we had for issuing bond, we have been talking to the government about potentially providing subsidy to people that would like to take up green and sustainable finance training. And the Financial Secretary just announced in his latest budget that he's going to do it. So we're now literally now working out all the details. And I guess the final leg on talent development is that we know that for those of you that are not so familiar with this topic, it's very difficult to pick the right course or pick the right qualification. And while we're developing the enhanced competency framework, in the interim, we need something. So we've been working with a group of market participants and academia to develop a repository of kind of quote unquote well-recognized qualification as well as training courses. And we're going to put it on our website so that those of you that are interested in taking up training can make reference to it. So talent is one key thing. So if I may, just kind of a slight digression into another area that we notice is also lagging is data. So, I mean, you're all in finance and I'm sure you know how important data is. And in climate risk management, in green sustainable finance, there are quite a lot of gaps in data. Sometimes it's that the data is simply not available. So say, for example, a good example that we often hear are the emission or climate risk exposure of banks' clients. I mean, the largest corporate, they have to report to the exchange, but for the smaller one, the data simply don't exist. And even if certain data exists, they could be scattering everywhere, in different financial institutions, in different government departments, or the resolution, quote unquote, resolution is not good enough. So again, here we're also working with our fellow regulators and market participants to try to fill those gaps. It's a painful process, I would have to say. It literally just go through each data gap and scratch our brain and see where we can find those data. So, but we're working on it, and we've published some of our findings on the website of the Center for Green and Sustainable Finance. So those of you that are interested can take a look.
Thanks, Ken. So we're definitely moving in the right direction with the repository under the website, with the subsidy from the governments to really drive that, and the data works going on. So definitely, I feel that it's definitely the pain, and we're all sharing the pain. But I think MA and the regulators and government, the agency, are taking a leap on taking these pains, right? So I'm very hopeful that this gap is going to be addressing. But since we're on data as well, Emily, you also mentioned the data point earlier. I don't know whether you want to respond to the talents piece, but also the data side, or maybe we start coming on to you on the key challenges as well on that.
Well, funnily enough, Tracy, actually, look, and you and I have known each other a long time now, so you know I only ever see these things as opportunities rather than challenges. But actually, there were a few things I could have potentially touched on here, and actually the one of talent hadn't even crossed my mind, but that it's real, and we're feeling that too. But actually, I was also going to focus on the one that we get asked about most often, which is data. So it's a nice segue to that. But look, it doesn't come as a surprise to anyone here that sustainability data is more advanced, more sophisticated, and more widely available in developed markets versus emerging markets. And that's largely for two main reasons. One being, company disclosures are just much less prevalent because the investor demand hasn't been there, the regulatory requirements haven't been there. And I might touch on that point about regulatory requirements and disclosures maybe later if we get to that point. But also third-party data providers are typically have lower coverage in this part of the world because their resources are often just concentrated in EMEA in the US. So what that means is that investing sustainably in Asia and other EM still requires a far more high-touch approach at the moment. You might be able to use third-party ESG as a useful proxy for data availability and quality, but analysts still might need to conduct their own proprietary research and company engagement to get what they need. Now, I'm internal optimist, and looking forward, I am actually seeing signs of this rapidly improving, particularly in this part of the world. We are seeing increases in disclosures coming from companies across the region, and that's driven by an increasing awareness of the importance of reporting on sustainability to investors, but also obviously the evolving kind of regulatory landscape. But also kind of where I see kind of, some interesting emerging additional sources that I think are things to watch in the space. First of all, specialized local data providers that have, this on the ground local presence and languages and gathering, information that might not otherwise be so easily accessible to international research houses. And that's particularly useful in geographies like China. And then secondly, we've got unstructured big data and machine learning. And that's been a real game changer for an investment perspective. And it really allows us to use tools that might reveal harder to measure financially material relationships. And so that might be, for example, something like weather patterns overlapped on top of physical infrastructure to map climate risk at the physical asset level, or doing things like web scraping to determine employee or customer satisfaction levels. So, that's where I see this space evolving and where I think it is one to watch at the moment.
Thank you. Rahul?
Sure. No, I think let me start off with Julian's second point. I think that was very eloquently put, and we are seeing that in terms of bankers becoming sustainable finance experts, and sustainable finance experts become bankers. We're seeing that transition happen. I think a lot of the second-party opinion providers, the more research minded folks, many of them have actually joined banks, as we've seen in the last maybe 6 to 8 months, and we see that sort of intermingling of knowledge and sharing of client experience. So both sides, I think, are learning to speak to clients on the same subject but with a different hat, and that sort of makes all the world of difference. So hopefully we'll get there, and I think that's a genuinely put problem that the industry faces. Just moving on to a bit on the data side of things, just given the discrepancy between the EM and DM markets, I think when I put that into what it means for transactions and what it means for issuers' reactions to their own transactions, we see that there is obviously discrepancy in terms of, let's say, when you're structuring sustainability linked bonds in terms of scope 3 data. Now that's a big issue in terms of oil and gas companies, for example, in the EMEA region. Many of them do disclose scope 3 targets. For example, in the US as well as in Asia, as well as some in the GCC, they don't disclose that data, or let's say they don't at least publish that data. Some may track it, some may not track it, etc. So I think there's obviously when you have clients across a variety of different markets and sectors with different mindsets, getting a well-structured transaction to an investor, I think that becomes that much more difficult because there's that many more opinions. And again, it's difficult to say which is right, which is wrong, because obviously everyone has a history and there's points for and against both sides. But obviously there's data. Again, I think this is one of those things that we can solve over time. It won't be automatic or overnight. And likewise, I think another sort of issue to mention here is around taxonomies and sort of which ones to follow, for while structuring green. Now, obviously, we see the EU taxonomy as one that is probably the most extensive, but we are obviously cognizant of the fact that number of regions and countries have come up with their own taxonomies over the last few years. So you could have issuers, and these not necessarily speak to each other very, very fluently. So you could have issuers in certain regions design certain things under their own taxonomies, which may or may not meet certain investor guidelines. And so I think predicting what every market participant would feel about a particular issuance is becoming that much more difficult, which probably in a more harmonized taxonomy might be a tad bit easier. But again, I think that keeps life interesting. So that's from my side, Tracy.
I like your positiveness of keep life interesting from the taxonomy perspective. So very good one. I'm conscious with the time. With this pool of experts on the panel, we can talk all day long. I'm very keen to move to the next segments of the future. So into the future, we want to share from your perspective from the future into the future from this sustainable finance market development. And just very quickly, according to the Standard Chartered Sustainable Debt Market Up and Up Await research, the report forecasts the global issuance of green, social, sustainable, and sustainability-linked bonds, so the GSSS category, will grow by 52% up to a 1.7 trillion this year. And to continue with the growth over the next few years to hit 4.2 trillion by 2025. So this is a huge number. So with this ahead of us, I want to hear from everyone on, into the future, what is the next big thing you see will help the market to scale up, in particular in Asia? And I would like to go back to Ken, to start with Ken on this point.
Yep, sure. Well, perhaps not surprisingly, from someone coming from a regulator, I think regulation is going to be the next big thing. What I mean is this. The green and sustainable finance market so far is very much an industry-driven, a market-led market. So say, for example, when we think about issuing a green bond, a social bond, we think about the ICMA principle. When we want to ensure the credential of a bond, we think of an external reviewer or a second-party opinion provider. So, and very few of them are actually regulated in most part of the world. And even the TCFD, which is the gold standard in disclosure, is also a very much kind of industry-heavy effort. So all these has been great, and it kind of underpinned the exponential growth of the market over the past few years, but it also caused some concern for greenwashing. And there are also some concern over what investing in green really means. So the way we look at it is that with more regulation coming out, which kind of codify the good practices and also set the minimum standard, it would help the market to grow further. Part of it comes in the form of disclosure and taxonomy, which Emily and Rahul mentioned just now. The other part of it comes from risk management. So as financial institutions better incorporate climate risk management into their own risk management framework, we're hoping that more of them would divert resources into those instruments or companies that are better managing their climate risk. And in other words, that are kind of more dedicated towards the green and sustainable causes, which in turn should hopefully drive more investment in this space. So regulation is where I see things ahead.
Thank you. I heard from multiple different regulatory sessions that, I think that's from Ashley. Ashley mentioned that regulation is the only area where sustainable finance markets are asking for. So no other market that people are asking for regulation except sustainable finance. I remember he mentioned a few times. So I think that's aligned with Ken, your comment on this. With this, I think let me go to Emily on this, because I think it's Thai from the regulatory disclosure sense that you alluded to. So why don't you go to you, Emily?
Yeah, thank you. I mean, just to play into that as well, look, from our perspective, the most critical requirement for sustainable finance to scale properly in APAC is for the regulatory environment to evolve in a manner that avoids fragmentation across the region. Because if that doesn't happen in a coordinated manner, we really do run the risk of only being able to approach these considerations in an ad hoc or domestically focused or boutique fashion in each market. And that's really going to limit your ability to scale. So in the interest of time, I won't go through like in too much detail, but there's three main lenses through which kind of we would kind of make recommendations here. First is what's being done in terms of corporate level disclosures. So we really welcome momentum behind global initiatives to improve availability, quality, and comparability of issuer level data. And we think the ISSB standards and how that evolves is something that we really support and we believe are going to play a really important role here. But also regulatory initiatives to make corporate climate-related disclosure mandatory is something we really support. Secondly, question around fund disclosure and labeling, because obviously transparency is really super key to addressing key greenwashing concerns. So in order to help investors make informed product choices, you know, this idea that regulators form ESG fund classification and disclosure rules that provide a standard terminology that describes sustainable investing strategies in order to complement the kind of robust corporate disclosures that I already mentioned. And then the third one, just playing into something that Rahul already talked about, is this question around taxonomies in terms of real world sustainable activities. Now, we do support efforts in various jurisdictions to build these different sustainable taxonomy frameworks because they have the potential to be valuable tools in helping define, you know, the transition to a low carbon economy, and it should help corporate and investment decision making. But the proliferation of taxonomies internationally does subject cross-border fund managers to taxonomy fragmentation. So you might see an economic activity carried out in one company as seeing green in one jurisdiction, but not in another. So, you know, there's a question around interoperability of taxonomies that you need to address before you create any rules that are based on those taxonomies. So that's what I'm passionate about.
We will definitely need to plug you into the Common Ground Taxonomy Working Group, Emily. Thank you. Julian.
I think both Emily and Ken covered a sort of like standard point. I think I would just highlight two things, right? I think one is technology breakthrough. I think for issuers, in particular, like for aviation, right? I think that a lot of the breakthrough is going to be through technology, right? Whether or not we're going to have hydrogen plane, you know, may start with a smaller electric plane, but not that it's going to be, you know, very applicable in Hong Kong at this point. But I think that over time, right, you will see technology breakthrough, right? And technology breakthrough, when there's money and there's a will, it will get overcome, right? I think when we see sort of how sort of like, you know, vaccine could develop in a very short period of time, when I think humanity present a big challenge to itself, it will happen. I think it's just a question of pace and time. I think if we have all had this vision, right, I think technology breakthrough would definitely, you know, with the help of the financing, right, it will come. I think the second point is also the talent, right? The talent issue. It's I guess for market, particularly in Hong Kong, right? I think that actually would also help, right? It comes with it means opportunity. When I sort of point out this issue, right? I think the whole ESG space or ESG finance space, right, it's still very early on in terms of evolution. We know that there's going to be a lot of work, right? And there's a lot of capital needs to be involved to get this done. And so there's actually a lot of opportunity that could be, you know, be it for undergraduates that, you know, looking for, you know, new field, or a fatigue and tired bankers on certain products in a down market to look for opportunity. I think this is a long and sustainable way, right, to develop a new way where leverage on the capital market expertise, but there's actually a new area that actually do some good in the world. So I think that obviously would come over time, but I think with this a will, and also with capital coming in, I think it will help.
Thanks, Julian. I cannot agree more on, we call it fintech, clean tech, green tech, this labeling. I think Ken and I were at, we have another panel on this one, and that definitely facilitate the transitions work in order for us to hit the net zero by 2050. With that, Rahul, can we come to you?
Sean, look, I think the point around regulation has already been mentioned, so I won't mention that. The second point I thought which would be really helpful, and this is me keeping my capital markets hat on, is that what issuers also need is an arbitrage for all the work that they're doing. So if I go back in time and I look at the Formosa market, when I look at the CNH markets, what they effectively offered investors, issuers, was at a point in time they offered some kind of an arbitrage in funding, and that's why issuers took the additional step of sort of reorienting their programs to be able to access these markets, even the panda markets. These sometimes may not be the most sort of easiest markets to access, because there's a lot of documentation change, et cetera. So there's a lot of education that has to sort of filter down. But it obviously was important because there was an arbitrage. Now, if I look into the green markets, obviously one of the first questions that we do get as sell-side bankers is, what is the arbitrage versus my conventional curve? And if I were to effectively thumb the table and say, well, it is 10 basis points on any given day, I think this market would become well, I would just simply add one more zero to that number from last year. So jokes aside, but the idea is that to make anything in the capital markets self-sustaining, and sorry to use the word again, but I think we need to find an arbitrage. And to be honest, issuers are going their way in terms of sort of reorienting their strategies, their marketing, putting their sustainability ambitions out there. And this is not easy because putting a 2030 target, 2050 target, no one really knows that much into the future whether they'll be able to meet these targets. But yet there are C-suite individuals who are putting sort of their name and their sort of targets out there. So I think at some point where we see the curves sort of providing a bit of an arbitrage, at least for some period, till we get to the final goal of all debt being sustainable debt, which means there is no arbitrage to speak of, I think that would definitely help this market also grow outside of clearly the regulation being one of the most important aspects.
Thank you. I'll hold the thought of the 10 basis point for the next sessions. And thank you all. I think I just realized the time. We are few minutes to the 4 p.m. and I need to pass this back to Susanna. But before that, let me just very quickly wrap it up, at least for my takeaway. So we definitely have heard all of our speakers on their sustainable journey for the past, the present, and future. And I think one thing is very clear, that the expectation to see the market to continue to grow even faster than now. And most important takeaway for me is actually how each of our segments, all of us, taking concrete action, no matter where we've come from in the market. And I think quoting, this is a quote from Larry Fink from BlackRock, to be the physicists will be essential to achieve the next net zero world. So on that, I will pass it back to Susanna, and please join me to thank everyone, all our speakers, for their insightful sharing. And Susanna, over back to you. Thank you.
Thank you, Tracy. Thank you everyone for joining this event today. We hope you all find today's roundtable insightful. There will be a feedback form on Zoom after the roundtable ends. Your suggestion will be carefully considered and highly valuable for us to plan the future events of the Alliance. Thank you and have a good day.
Thank you.
Thanks, everyone.